We are officially heading into 2026, and I think now is the perfect time to make some serious investing moves that are going to set you up for financial success in the new year. Instead of waiting until February, March, or even June to get your finances in order, you should really be thinking about these things right now, at the beginning of the year while you still have momentum from the new year. I mean, that's the whole point of New Year's resolutions, right? You set your goals and try to accomplish them while the motivation is high. So in today's video, I have a list of 7 investing things you absolutely must do in 2026 to really take control of your wealth and build it over time. And I mean this seriously, because these are the kinds of moves that when you do them now will compound and make a massive difference down the road. By the time you're retiring in 30 or 40 years, the decisions you make today will have snowballed into an enormous amount of wealth. So if you're ready to take your investing to the next level and you want to be crushing your financial goals, let's jump into number 1. All right, so number 1 on our list, and honestly, I think this might be one of the most important things you can do in 2026 to make sure you are maxing out your retirement accounts. Now, I know that sounds like a pretty big number, but hear me out because the benefits are actually going to be incredible. Starting in 2026, the contribution limit for a 401k is going to be $24,000 per year for those under the age of 50. If you're over 50, there's a catch-up provision that gets you to around $30,000 annually. Now, I get it. That's a lot of money for a lot of people. But here's the thing. If your employer offers a 401k match, you absolutely need to at least get that free money first before you even think about investing in anything else. Seriously, this is money that your employer is literally handing to you and saying, please take this. So if you make, let's say, $100,000 a year and your employer matches up to 4% of your salary, that's $4,000 in free money per year. That's crazy to me that anyone would leave that on the table. I mean, think about it. If your employer is offering to give you free money and you don't take it, you're essentially leaving compensation on the table. That makes no sense to me. So the first priority should always be to get that full employer match before you do anything else with your money. Now, if you're self-employed or if your employer doesn't offer a 401k, what you can do instead is open up something called a SEP IRA or a solo 401k. These have much higher contribution limits than a regular IRA. So if you're someone who's making good money on the side through freelancing or running your own business, you definitely want to look into those accounts because the contribution limits are way higher and you can basically put away a much larger percentage of your income on a tax-deferred basis. A SEP IRA, for example, allows you to contribute up to 25% of your self-employment income, or around $69,000 for 2024, which is way more than a regular IRA, and it gives you serious tax advantages that can help reduce your tax burden significantly. Now, the other retirement account that you absolutely need to have in your arsenal is the Roth IRA. I cannot stress this enough. The Roth IRA is legitimately one of the most powerful wealth-building vehicles available to anyone in America. So the way it works is you contribute after-tax dollars to the account, but all of the growth inside that account is completely tax-free forever. That's a pretty insane benefit when you think about it. So if you contribute $7,000 this year and that money grows to say $200,000 in 30 years, you don't owe a single penny in taxes on those gains. Compare that to a regular brokerage account where you would owe 15 to 20% in capital gains taxes. That's the beauty of the Roth IRA, and it's why I think everyone should prioritize maxing this out if you have the means to do so. So if you haven't maxed out your Roth IRA for 2026, you should absolutely do that as soon as January hits. You can only contribute $7,000 per year, and you cannot make up for it later. If you don't max it out by December 31st, that opportunity is gone. The clock is ticking, and you want to get that done early. Number 2 is something that I think a lot of people overlook, and that's actually rebalancing your investment portfolio. What does rebalancing mean? Basically, it means making sure that your portfolio allocation matches the target allocation you set for yourself. And it's actually one of the most underrated investing moves, in my opinion. Let me give you a concrete example. Let's say at the beginning of 2025, you decided you wanted a portfolio that was 60% stocks and 40% bonds. Maybe you had $100,000 at that point. So $60,000 in stocks and $40,000 in bonds. Now, let's fast forward to today at the end of 2025. The stock market has had a really good year, and now your portfolio is worth, let's say, $115,000. But because stocks performed so well and bonds didn't do as much, your allocation has drifted. Now your portfolio is actually weighted 70% stocks and 30% bonds. That drift happened organically because stocks outperformed bonds. So now you're actually taking on more risk than you originally intended, and you might not have even realized it. This is where rebalancing comes in. You would sell some of your stock positions and buy more bonds to get back to your original 60-40 allocation. The reason rebalancing is so important is because it forces you to sell high and buy low, which is exactly what you want to do as an investor. It sounds really simple, but most people don't actually do it, and they end up with portfolios that are way too concentrated in whatever asset class is hot at the moment. Now, I will say that rebalancing does have some tax implications if you're doing it in a taxable brokerage account, so you want to be mindful of that. But in retirement accounts like your 401k or Roth IRA, there are no tax implications, so you can rebalance freely without worrying about triggering capital gains. I would suggest that you rebalance your portfolio at least once a year, maybe twice twice a year, depending on how much drift you're seeing and how aggressive your allocation is. Some people like to set a threshold, like if my allocation drifts more than 5% from my target, I will rebalance. But honestly, once a year is plenty for most people. So at the beginning of 2026, take a look at your allocations. If they don't match what you intended, make those adjustments now. This is a perfect time to do it since the year is fresh and you can start 2026 with a properly balanced portfolio. Number 3, and this one is really important, to diversify across different asset classes. A lot of people think that investing just means buying stocks, but there's so much more out there. You should have exposure to bonds, exposure to real estate through REITs, exposure to international stocks, and maybe even some commodities or precious metals. Now, I'm not saying you need to own every single asset class out there, but I do think having a diversified mix across different categories is going to reduce your overall portfolio risk. And honestly, that's the whole point of diversification. You're spreading your money around so that if one area tanks, your entire portfolio doesn't crater. Here's what I like to recommend for most beginners: a simple 3-fund portfolio. This includes a total US stock market index fund, an international stock index fund, and a total bond market index fund. That's it. That's literally all you need. If you can build a portfolio around those 3 funds, you're going to be in excellent shape for long-term wealth building. The beauty of this approach is that it's simple, low cost, and diversified, and once you set it up, you don't have to think about it very much. You can just let it compound over decades. This is exactly what Warren Buffett recommends for most people. He's one of the greatest investors of all time, and he says most people should just buy index funds and hold them for the long term. If it's good enough for Warren Buffett, it's definitely good enough for us. Some people like to get more complex and add rates or commodities like gold, and that's totally fine. But I think the 3-fund approach is the easiest way to get started with proper diversification. For most people, it's probably all they'll ever need. Number 4 is to implement a tax loss harvesting strategy. I know that sounds complicated, but it's actually pretty straightforward. Tax loss harvesting is when you sell investments that are down in value to lock in losses, then use those losses to offset gains elsewhere in your portfolio. For example, let's say you bought a tech stock for $5,000 and it's down 15%, so you're sitting on a $750 loss. Meanwhile, you bought dividend stocks for $3,000 that are up 20%, giving you a $600 gain. You could sell the tech stock, lock in the $750 loss, and use $600 of that loss to offset the gain. That leaves you with a $150 loss you can carry forward to future years. You do need to be aware of the wash sale rule, which says you can't buy the same or a substantially identical security within 30 days of selling it for a loss. Otherwise, the IRS won't let you claim the loss. But you can be smart about this by buying a similar but not identical security during that period. Number 5 is to review your investment expenses. Every mutual fund and ETF has an expense ratio, which is the percentage of your money that goes toward fees every year. If you're paying 1% on a $100,000 portfolio, that's $1,000 per year in fees. Over 30 years, that can cost you hundreds of thousands of dollars in lost returns. Low-cost index funds often have expense ratios under 0.05%, while actively managed funds can charge 1% or more. In 2026, take the time to audit every fund you own and look for lower-cost alternatives. Even small differences in fees can add up to massive amounts over time. Number 6 is to make sure your investment time horizon matches your portfolio. If you're 30 and investing for retirement at 65, you have a long time horizon and can afford to take more risk. But if you're saving for a house down payment in 3 years, you shouldn't be aggressively invested in stocks. Match your investments to when you'll need the money. This simple step prevents unnecessary risk or unnecessary conservatism. Number 7, and finally, is to establish a dollar cost averaging strategy and stick with it. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. It removes emotion from investing and helps you build wealth consistently over time. The key is to automate it so it happens without you having to think about it. Set up automatic transfers and automatic investments. Let compounding do the heavy lifting. Alright, so those are the 7 things you absolutely must do in 2026 to set yourself up for investing success. If you implement even a few of these, you'll be in a much stronger financial position by the end of the year. The best time to start investing was 20 years ago. The second best time is today. Investing is a marathon, not a sprint. Focus on consistency, and over time, those small improvements will compound into serious wealth. If you enjoyed this video, hit that like button and subscribe for more investing and personal finance content. I'll see you in the next one.